Ladies and gentlemen, please put your hands together for the fantastic Paul Pritchard, who's going to give us some insight to the wonderful world of TCFD, etc. Paul, over to yourself.
Thanks very much, Sarah. And I'm going to start off with a very quick reminisce, if you'll allow me, in that for many years, for someone who's worked in finance for a long time and been doing environment first, then sustainability, normally when I do a presentation, I would start off with an admission, that, my name's Paul and I work in finance, and, expect the kind of low level boos and hisses and things like that. And there still are some people that think that I'm doing the work of the devil, not just me, collectively, but thankfully it's changing massively. And just as you said, it's a reflection of a lot of the activity that's been going on, well, really, yeah, like you're saying, the last 12, 24 months, a little bit longer, has been the real period of change and development within the sector. And one of the things that struck me just as you were, in fact, as we were going through the speakers today, I was actually rapidly making notes and changing it to reflect on things that people were saying. And for a long time saying, well, I'm sorry, we don't really do that. And there's nothing going on in the sector in regulation. And wouldn't it be great if we had some standards and governance around this? Actually, there are things in place and coming in place. So I think we're already seeing a lot of early signs. And if we take regulation, for instance, it's been a bugbear of mine for many years that the kind of overarching global regulatory framework for finance, the kind of post-war system, looked at risk and looked at financial risks to the system, didn't look at anything like climate or environment. It just looked like a huge gap in there. That's definitely changing. So we're seeing, for instance, the guidance that came out towards the end of last year from the European Central Bank, which provides guidance to the national regulators, telling them what they expect to see in terms of governance and management, specifically around climate and environmental risks at the moment. But I think the social risks will actually get in there. And in fact, looking at governance, when we were talking about that, I think it was really interesting, because one of the things that came to mind straight away is something called the senior managers regime in UK finance, whereby, fairly simple measure, large finance organizations have to have a named person who's responsible for climate issues, and it will be environment. And you won't see a lot about this in published sustainability reports, but I can absolutely tell you for sure, when you have that individual named as being the person responsible, they're going to make sure that they actually understand this and that the things that are reported don't reflect badly on them. So there's like small things like that are mandatory coming through the regulatory regime, may not seem a huge deal outside, and nobody's going to say, oh, now we've got somebody, a named individual who's responsible for it. Of course we have, we've always taken this seriously. But actually, little things like that, maybe not such a little thing, has quite a big effect. The other thing I was going to say, and it came right through from Tobias right at the start, is that a lot of the activity in this space to date, and will be going forward, although I think the emphasis is going to be changing going forward, has really come from the investment community. And the investment community is not finance. It is part of finance, but it's not finance. The banking bit of finance is huge, and the insurance part is pretty big as well. Obviously, investment's important as well, but there is a lot more to finance than just investment. Just investment is an important thing. And the other thing is that these subsectors, if you want to call it, have very different perspectives on life, the universe, and everything. They have very different cultures, they have very different risk appetites. And I think that's reflected in the way that initiatives have been developing to date. So we've had the responsible investment community and activities for a long time. Initially, it was a lot very close to ethical investment. So it's about not investing in activities that were deemed to be undesirable. alcohol, gambling, those sorts of things, latterly climate change, those sorts of issues. So there is that history there, and divestment is still a tool within the investment armory, but actually that's changing, and there's a much more informed approach, I would say, actually looking at what is the responsibility of the investors and how can they support the transition to sustainability, rather than saying, oh, we're just holding all tech shares and everything's wonderful. Actually, should we be working with these sectors that have a role in sustainability or need to transition, and how can we influence them and support them? So I think it's a change of mindset within that community. The investment community, I think, starts from a position of thinking about opportunity. So it's looking at, can it develop new services? Can it develop new products? Can it develop funds? And that's the way it's thinking. And there is a lot of money looking for good homes going forward, not just because it's a good idea from a long-term strategic perspective internally, but also reflecting consumer sentiment as well. People want to know that their money's doing good and part of the transition. So I think that's happening. Within the investment world, there's quite a heavy reliance on third-party data providers, and quite often they have proprietary approaches to ESG. So I think we're probably at the stage now where companies are being faced with more than one ESG approaches, and they're not necessarily all compatible, if I put it politely like that. But I think moving forward, there is a lot of sense that this isn't a great situation, and there is quite a push to think, how can we make data collection consistent, and how can we make sure that we're all relying on the same data and it's good quality and so on. That'll be around the climate space first, for sure, but then as it expands, it will look at the other elements of sustainability as well. So I think that's the investment world. Developments like the taxonomy, EU taxonomy is a big one, but there are lots of other taxonomies as well. There are issues around taxonomies about what's green and not green, and we could talk for hours about that. But I think one of the things that I found, particularly with the EU taxonomy, is the technical guidance that supports it is great. So you've got a massive sector by sector discussion on how a good company in this sector should operate. I mean, it's limited at the minute, but it's a really good technical resource for people looking at this, not just those that want to say something's green or not green. So I think there's a lot of interesting stuff there. But like I mentioned in the title of the presentation, this is supposed to be about TCFD, the Task Force on Climate-Related Financial Disclosure, and that reflects a more banking and insurance kind of focus towards risk. So whereas I think it isn't a binary thing, but from the investment community, it would be looking at, you know, what sort of products, what sort of funds can we develop? From a banking insurance, the first response would be, what are the risks associated with this, and how do we respond to it, and how do we manage it? And TCFD really came out of that from a high level concern about whether climate risks in the first instance posed a financial risk to the whole stability of the global finance. So it's actually an important thing to recognize that it's actually talking about financial risks rather than impacts. And I think the whole debate that's come out of TCFD is really, really interesting, not fully resolved, but there is a real difference between what might be a financial risk to a bank or an insurer or an investor, and what the actual impacts on the environment or on local communities might be. And that's tied up with some of the debate that we heard earlier about materiality of social issues. So understanding materiality and the discussion and debate that's going on around deciding what is material for an organization, non-financial reporting, is really central to this and central to what TCFD might develop into. And I'm guessing there are a number of organizations represented today that are already producing TCFD reports, and if so, That's great. And you are positioning yourself well to deal with the anticipated challenges that I think will be coming from the finance sector in the future. However, I would say that a lot of the reports that I've certainly seen do cover the main elements that are covered in the TCFD guidance about strategy, governance, and impacts. And that's great. But I also look at them with a banking or an insurance kind of hat on and think, I can't understand the risk from this disclosure. And that's what they want to be doing. And it comes back to the things, echoing what people have been saying today. A lot of the risk is going to sit in the supply chain. And if you don't understand where your supply chain is and what the relationships are and what the dependencies are down the supply chain, you can't understand the risk associated with the organization and where the impacts are. So it's not just about own organization, it's about the whole value chain. And as you were saying earlier, that on the opportunity side, how this actually links to strategy. So is this an organization that's going to be around in a few years or 10 years or 20 years or 30 years? Is it producing the materials that are going to be needed, or is it in an area that's going to disappear or be much more heavily regulated or have restricted demand? So those are the sorts of questions that I don't think come through strongly yet in most TCFD reports. That's not surprising. It's still early-ish days, but that is going to come through, assuming we get a good TCFD. And on the question of sort of mandatory and legal requirements about TCFD, the UK is actually, government's consulting at the minute on making TCFD mandatory. In a way, I think that's a red herring, because assuming we do get this good TCFD, the banks and the insurers and the investors are going to want to know this information anyway. And there probably is going to be a condition of making loans or offering insurance covers or prior to investment. So it's actually getting this into the mainstream, I think, could actually be an absolutely fundamental step forward in the sector supporting transition to sustainability. Now, I was just going to say 2 or 3 quick things at the end. I'm actually saying completely different to what I'd written the notes for, reflecting what people said earlier. So hopefully that's okay. I think some of the areas where the work going on within the finance sector now might be of broader interest and use to other sectors, I probably couldn't have said very much a few years ago. In fact, I would have struggled to say, you know, what can we tell you about this? But I think the work thinking about timescales, how to accommodate different timescales in impact, that, you know, what's near term, what's longer term, and how you address those in terms of strategy, risk appetite, and so on is a really interesting area. Scenario analysis, absolutely centrally as a way, an approach of dealing with uncertain futures. And so I think if I look at some of the materials that are out there, I'd certainly suggest it's worth a look at the TCFD hub. There's masses of information on there, but I think particularly within that, there's the cfrf, the Climate Financial Risk Forum. I get some acronyms in, and there's the sort of state of the art, I would say, particularly around scenario analysis, about strategy, about governance and everything else. So there's some really good stuff there. I think it gives an indication of, assuming we get a good TCFD, the way it's going to go. But I think so it'll inform what organizations are going to be asked. But as well as that, it's actually quite forward-thinking stuff as well. So I think it would be interesting, for instance, around scenario analysis. So mindful of the time, and apologies for going on, I leave it at that, and thank you for the opportunity for talking.
Brilliant. Thank you so much for that, Paul. Round of applause, ladies and gents, from behind your microphones for the fabulous Paul Pritchard. So Paul, we've been, by the way, if anybody's thinking, sorry, what is TCFD, etc.
Oh.
No, it's all good. We have been putting the links, and I feel very smug that we had the link to the TCFD hub in the chat before you mentioned it. So that's a case there where these are all rules, regulations, etc., that are coming through in that financial space, and they've literally only come in what the last 12 months or so. And so actually pushing the world of banking, insurance, etc., to perhaps shine more transparency with regards to, say, climate change. Is that correct, Paul?
Absolutely, absolutely. I mean, TCFD has been around for a few years, but it's kind of been kicked around what it means, and within the sector, the focus tends to be on portfolios rather than individual companies. So there's a lot of interest in how you can look at a portfolio of organizations by sector and so on. So there's been quite a lot of area in that, which I think has meant that the pressures haven't yet fed through from the sector other than in the investment world. So the ESG questionnaires and everything that are coming through, there's actually this TCFD, if I can say it properly, stuff coming down further down the line in the next year or two. And then after that, we've got the task force on nature related financial disclosures. So that's following down, that's likely to appear next year, and kind of extends it to looking at more nature related issues as well.
And when you mentioned right at the beginning that the social side is perhaps a little bit absent at the moment. When do you think more of the social aspects might be coming through in that?
Well, it is interesting because I think there was a lot of discussion around materiality and how do you define materiality and what does materiality mean? And historically, materiality would mean for a bank or for an insurer mean something that results in a loss of greater than X million pounds or something like that. That's a material issue. And if it didn't result in that within a 1 to 3 year timescale, it's not material. So clearly that doesn't work for an issue like climate change or indeed for social issues. Of course, you can still get legal cases and employee issues and supply chain and local, you can get all those, but it doesn't usually register. So the discussion on materiality, and there's been some very good guidance come out recently from the Financial Reporting Advisory Group, EFRAG, about materiality and about non-financial materiality. So this is the interest of third parties that might not result in a direct financial loss to the organization, operational loss, but who need to be taken into account. So I think the social issues will come through that route and be integrated in it. And also as well, when you get the nature related stuff, water issues is one area where I think this will come through very early, and local rights and things related to water are actually going to come through pretty strongly from looking at climate. They're all interconnected anyway. So.
Brilliant. Thank you for that, Paul. And I noted Susan's eyebrow twitch when you mentioned that word materiality and what it means, because actually the word materiality means different things to different people.
Yeah.
And I think that's something that is crucial for all of us to acknowledge. But you make a fantastic point there, Paul. So brilliant. Ladies and gentlemen, please put your hands together for the fantastic Paul Pritchard. Brilliant. Thank you very much, Paul.